Hey, what's up, guys? I appreciate you tuning in. First off, I want to make it very clear that this is not financial advice, and the ideas I share with you in this video are for the purpose of education only. I'd really appreciate it if you could like this video and subscribe to my channel. It helps me out way more than you know. We go over some super valuable concepts, so enough with the chit chat. Let's get to it. Hey, what's up, guys? In today's video, we're going to go over what equilibrium is, how to identify it, why it's relevant, and how to use it to frame proper trade setups. So before we begin, I want to make note that this video is the first of many in this playlist, and that is because it is a foundation of learning price action. So I want to make sure I emphasize that. I also want you to remove all indicators besides volume. Price action is all you need to trade with the concepts I'm going to be giving you. The only tools you're going to need is your Fibonacci retracement tool. You need to turn on the 1, 0, and 0.5 levels in your settings, and you can also use a parallel channel. I want you to be patient because what you're learning is the cornerstone of many trade setups we are going to go over in the future. And it may not all come together just yet, but I promise, just trust me, you're going to need it. Another thing I want to make note of is to keep in mind when you're trading that you are riding the wave created by someone with far greater buying power than you. I like to say that we're following the breadcrumbs that someone with a whole loaf has left for us. The first and most essential thing that any trader needs is brutally simple, right? It's price movement. And that movement that we need is something that we cannot initiate. That movement takes massive buying power. So, what is equilibrium? Equilibrium is a term used to describe the midpoint or median of a trading range, order block, or fair value gap. Equilibrium can also be considered a fair market value for the asset to be trading at. In order to have equilibrium in a trading range, we need consolidation. Consolidation is when price is moving in a definitive range, trading sideways, has very clear highs and lows. Discount, right? This is where you want to be a buyer. This is when you're trading below equilibrium or fair market value. And on the other hand, we have premium, where you're trading above equilibrium or above a fair market value. Common sense states that we would want to buy any item at a discount and sell it at a premium. So you must do the same with the assets that you're trading. Keep in mind that many low time frame ranges can be found within one high time frame range, and there is no definitive range, but the higher time frames do hold more relevance. Price action with your Fibonacci tool and parallel channel is all that you need to determine equilibrium. You don't need RSI, you don't need tons of indicators. All that is just going to cause paralysis by analysis. Just go ahead and throw that out the window. Top-down analysis is very important to start at the 1-day chart and scale in because, like I said before, the higher time frames have more relevance. They have more data to go off of, and this is what banks, whales, and other institutions are generally looking at when they're defining these ranges. One way to look at equilibrium is by drawing a parallel channel over the range that the asset is trading at, right? Again, to retouch on equilibrium, it is the midpoint, right? This midpoint can be derived from a trading range, order blocks, fair value gaps, whatever. Equilibrium is just the median. The market is trading at equilibrium, then the price is at a fair market value. Smart money will never buy above fair market value, and they will never sell below it. Expansion always will begin from equilibrium. When consolidation is occurring, Price is squeezing in a range, letting orders build up on both sides of the market prior to the next move. You can always expect an expansion from here. Once price has returned to an area of equilibrium, it's trading at a fair market value. So think, if you're paying a fair price for something, you're not paying extra, nor are you getting a discount. Nevertheless, you're not buying or selling at an inflated price. Oftentimes, after reaching equilibrium, price will move back to a recent area of institutional order flow, such as an old high or low, order blocks, or fair value gaps. I just want you to focus on the concept of identifying a trading range and being able to pinpoint equilibrium, because this is going to be the foundation you need to understand and develop other strategies to catch the moves we're speaking of. So, back to fair market value. Once price is below equilibrium, it is below the fair market price, which means you would be buying at a discount. If the high time frame bias is bullish, when price comes below fair value, it should be bought up quickly and move fast away from equilibrium. When the high time frame is bearish, when price is above equilibrium and above a fair value at a premium, it should be sold off quickly. The main takeaway I want you to have from this is that we don't buy at a premium and we don't sell at discount. Common sense, right? So don't overthink it. Don't get too sucked up into wondering how to find entries just yet. When you're just learning, it's more important to understand the foundational concepts before trying to leverage them in different strategies that you derive from them. Otherwise, you'll be a house of cards. So it's really important to get the fundamentals down before moving to the advanced techniques. So, when price is consolidating, orders are building up on both sides of the market, and liquidity is being engineered in the form of stop loss orders being placed above major highs and below major lows. You can always expect a major move at some point from consolidation, right? You have to have consolidation to have expansion. We always look for a dynamic move in price away from equilibrium, resulting in a major break of structure or breaking the market extremes such as the highs or lows to confirm this expansion. So how do we use it? After price makes a run to market extremes, you can wait for retracement to equilibrium, aka fair market value, and if the price is remaining the same bias, ideal trade setups on the lower time frames will reveal themselves and make for a dynamic push away from equilibrium. This goes for premium or discount, right? If you're in a bearish bias, ideal short setups on the lower time frames will reveal themselves, and vice versa with discount. Another way to use equilibrium is use a low time frame range, right? So say if you're playing off of that higher time frame dip back down to equilibrium and you're looking for a trade entry, you can use the low time frame range to determine which entry you're going to take. For example, if there are two entries, one right above equilibrium and one right below, and you're looking to go long, then you're going to take the one in your favor. You're going to take the one in discount. Just like you're waiting for the high time frame to retrace down to discount. Same concept. This can be used across any time frame. Equilibrium is also useful when plotting order flow, such as fair value gaps or order blocks. You can find much more precise levels by using areas of equilibrium of these different tools you're going to use to identify institutional order flow. Equilibrium is also used when you're playing the return to origin trade setup, which we'll cover in the next video. So a couple tips and tricks that I want you to keep in mind. There are dozens of trading ranges on the 1 hour chart within the daily range. There are dozens of ranges on the 1 minute chart for a trading range on the 1 hour chart. All of these ranges have their own equilibrium, premium, and discount. So I want you to kind of get the proper trading range out of your head because it can confuse you. Now, like I said, the higher time frames definitely hold more relevance, and you should always do top-down analysis to ensure you're getting the highest probability setups. The key to finding a correct range in whatever time frame you're looking at is identifying displacement. Displacement occurs when a whale, aka someone with a lot of money, a bank, institution, hedge fund, whatever, comes into the market with a strong and clear intent to move price in a certain direction. This can be identified by swing highs and swing lows, and we're going to get into that right now. All right, so here we have AVAX on the daily chart as I said before, we always want to start on the daily and do top-down analysis. This is usually the part people get tripped up on, is drawing the current range. Remember, I said there's not necessarily a right or correct range to rule them all, or everybody would just draw from all-time low to all-time high. Sure, while this is a trading range, it is obviously not going to give you precise results, right? So, how are you going to define the trading range you're in right now? Well, I like to use strong lows and strong highs, right? And what does that mean? All it means is after that swing, right, we had an impulsive move in price away from that high, right? And we broke market structure. When I say we broke market structure, I mean we broke the lows of the previous range, right? We broke down from there. So now that you understand that, we have our two strong lows and strong highs right here. Now, here we had an expansive move from price down into a new trading range, and from here we came up and did what? We actually broke that high. Now you have a new swing high and a swing low, right? This is going to be your trading range. So now that we have established that, and we're on the daily time frame, remember, we can look at the asset and say, well, as soon as this asset dips down below fair value, we tend to make a move to the upside. So that may lead us to believe we are in a bullish high time frame narrative, right? We came back down, exploded from this low, took out the highs of the range, and now every time we come down under fair market value, we move back to the upside. And here is where you're going to find those trade setups, right? Now remember, we're on the daily time frame, so once you drew this expansive swing in price, you had days of doing nothing, right? You were doing absolutely nothing here except waiting for price to come back down to give you a trade setup on the low time frames, right? Price came back down, stayed here for it was 3 days, boom, up to the upside. And then what? We cleared more structure here, right? Price comes back down into equilibrium, stays just a little bit longer here, but then what? Comes up, breaks structure again, right? One thing I want to point out is to have a swing low and a swing high, you have to have 4 candles, right? One candle before the high, that is a lower high, and then 2 lower highs after the major high. That is the only way to define a swing high or a swing low, right? If you don't have that, then that's not the swing high or swing low. So always check and make sure you have that done properly. This holds true on all time frames, whether it's the 1 minute or the 1 day. Now, once you understand this, you'll be able to draw trading ranges across any time frame, big or small. While, again, I always recommend starting from the top down. Now that we've established that, we can also find trading opportunities within lower time frame ranges. So now that we have a bullish narrative, we can look for longs when price comes back down under equilibrium. You can also use these same trading ranges to find possible setups and differentiate between them. For instance, right here we have this fair value gap. And we'll go into this later, but I'm going to give you an example here of how you can use this. So sure, you could have gotten an entry off of playing the bounce from equilibrium of the fair value gap, but it is actually a lower probability trade. Why? Because it is in premium. Remember, we do not buy in premium and we do not sell at a discount. Instead, you would find this order block at equilibrium or at fair value. And we have demand at fair value. That is a sound trade. That is a high probability trade. And as a trader, you want to limit the trades you take to high probability trades. And if you're buying, it must be in discount or at a minimum at fair market value. You can also use equilibrium of the order block in itself as an entry. Now, Well, I recommend if you're on the higher time frame, scaling it even more, and oftentimes you'll find another order block or another entry around equilibrium. You can use it as something to go off of when you are just starting on the high time frames. Now for fair value gaps, right? We have right here this gap in price. How would you use equilibrium here? Well, you would enter the trade if you were using this tool at equilibrium, right? Look here. Sure, this did pay, right? It did. You entered here. You were not in the negative for long. Price exploded to the upside. But we were waiting for the higher probability trade. This can be done on a 5 minute, on a 4 hour, on a 1 day. It's up to you. I always recommend using the high time frame to get your bias and then scaling down to the lower time frames to get a better, more precise entry.